As we near the end of 2023, I think it's time to take another look at the infamous QYLD, XYLD, and RYLD. As we recall, these were the perennial funds, the ones that were max cash flow, ideal for the average Joe investor, and their popularity has waned since then. That being said, from an assets under management perspective, QYLD in particular still is blowing away any other type of covered call ETF out there. We're going to take a look at their historical results year to date against their underlying indexes that they try to match. We'll look at the income and of course bring up the question again, do these funds deserve a place in your portfolio? What's up, you guys? Welcome back to the Average Joe Investor channel. For your awareness, this spreadsheet and all of the data underlying it for all of these different ETFs, as well as all of the other spreadsheets that I utilize on my channel, are available to you as a member of the Patreon community. And that also includes access to my own trades in my portfolio and access to the Discord community. So if you're interested in getting value out of that, check out the link down in the description below. For those of you living under a rock that do not understand how these funds work, here's a quick recap. QYLD, XYLD, and RYLD are all covered call ETFs. What they do is they own an underlying index. For QYLD, it's the NASDAQ 100. For XYLD, it's the S&P 500. And for RYLD, it's the Russell 2000. So step one is they own the underlying index, but that's not where they stop. They continue to then write covered calls, aka they utilize options to generate additional cash flow above and beyond the income generated from the underlying assets in the ETF. And it is very much a rules-based approach. They write monthly at-the-money covered calls. And this has led to a significant level of income for all of these ETFs over the past few years. Currently, QYLD yields 12.65% on an annualized yield basis, and they generate monthly distributions. XYLD currently has a trailing yield of 11.41% with monthly distributions, and the Russell 2000 has a yield of 13.49% currently and pays monthly distributions. But the big knock on these funds has been historically, well, that's great, they generate a lot of income, but these are assets that are losing value over time. The very nature of these ETFs means that with at-the-money covered calls being utilized, you generate a lot of cash flow, but you can't generate any capital appreciation unless you take some of that income off the table and reinvest back into more shares of the ETF. And that's what we've seen historically, for example, with QYLD. You can see over this time frame, all the way back to 2012, 2013, continually going down and then up and then making lower highs here and then down here and then down here and then down here and then here, and it's really down here close to 17 currently. So with all that said, let's take a look at how these three ETFs, QYLD, XYLD, and RYLD, have performed year to date compared to each other based on both overall total returns as well as income generated, but also compared to their indexes that they're trying to track, or at least that they're owning as part of their investment strategy. First off, let's take a look at QYLD versus XYLD versus RYLD. This is total returns. This is investing a lump sum investment of $10,000 at the beginning of the period, January 2023, and just reinvesting all dividends along the way. What would the portfolio be worth? In red, we have QYLD. In green, we have XYLD. And in purple, we have RYLD. And we can see that the top performing ETF of the three was QYLD. These funds were pretty much bunched together here through about March of 2023. And from there, IWM fell off a cliff, and this has to be the banking crisis that we experienced because IWM is definitely heavy on small to mid-sized banks. And that could be a reason why this has been impacted so far for this year. QYLD started with 10,000, ended with 11,972, inclusive of all dividends paid and reinvested. XYLD started with 10,000, ended with 10,905. And then RYLD down here started with 10,000, ended with $9,986. Essentially, it was flat on the year. Here's a look at QYLD compared to its underlying index. In the dark red, we have QYLD, and in light red, we have QQQ. And this is not surprising to most people here. And you can see just how this fund QYLD works compared to a QQQ. Right here, when we had a huge run up in both QQQ and SPY, you can see we jumped huge from $13,000 here up to, what was this? $14,000 in just, 2-3 days, maybe a week? Whereas QYLD went from 11,358 up to 11,800. So a much smaller increase, which is what we would expect. Here's a look at XYLD compared to the S&P 500. And this one was much closer. We can see that these funds were pretty much the same all the way through about the end of May 2023. And then the S&P started to outperform. We see the same run up in the S&P 500 here compared to the lower amount for XYLD. And from there, that's really where the majority of the outperformance occurred here at the last part of the year. And then lastly, we have RYLD versus IWM. And you'll notice here that these funds were pretty close together the majority of the year. We had a little bit of outperformance by IWM here right around the end of July, August. But for the majority of the year, they were pretty close together. But of course, IWM outperformed. And this is what you can generally expect with a covered call ETF that is writing especially at the money covered calls. Max income, but no real capital appreciation unless you take some of that income off the table and reinvest back into more shares. If we experienced in 2023 a drop in the markets, we would see that QYLD, XYLD, RYLD most likely would all outperform their indexes. However, since all of these indexes are up on the year, that is why we see underperformance by the QYLD, XYLD, and RYLD funds. And here's a look at the income comparison for QYLD versus XYLD and then RYLD. In red, QYLD, and in green, XYLD, and in purple, RYLD. We see that QYLD has the most income, and which is what we would expect, since the underlying NASDAQ 100 has the most volatility compared to the other two. And then we have RYLD in second place with their income being higher, and then the S&P 500 in green, the lowest. Here's an overall look at these funds compared to each other. Highest yield again is RYLD, then QYLD, then XYLD, and then of course we have really low yields for the other three indexes. Dividend income for the year to date was highest with QYLD at $1,244.70 under this scenario of a lump sum $10,000 investment at the beginning of the year. $10.89 for RYLD and then $10.22 for XYLD. And then you can see the portfolio balances here. What is the takeaway here? Do these funds make sense for you? Well, for the longest time, what it really comes down to is what are you trying to accomplish? These funds are in a relatively simple way to generate cash flow if you do not want to handle your own investments, if you prefer to live off of cash flow as opposed to selling shares in your portfolio. In many ways, you can say that funds like QYLD, XYLD, RYLD are very much a good replacement to like an annuity. Remember, with an annuity, you give a bunch of money to an insurance company or an annuity company, and then they guarantee payments for the rest of your life. And then more than likely at the end of the term, you don't get any money back. When you die, the money's gone. Whereas with these funds, they generate really good cash flow. And yes, we can expect them to go down in value over time. However, we can also expect them to continue to make significant and stable monthly cash flow payments as well. So if you're not living on cash flow now, these investments do not make a lot of sense. Hopefully you found some value in this video, guys. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.